Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. Let's talk about trading wisdom that still rings true 120 years later. Now, Jesse Livermore was a trading legend, and at the turn of the millennium, the last millennium, actually it was the one before, the 1900s one, his life as a trader was memorialized in a book called Reminiscence of a Stock Operator. And if you haven't already read it, you should. It is one of the best investments for your development as a trader. So today, let's explore some of my favorite trading rules that Jesse Livermore lived by. Hi, it's Phil. Welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options, and index futures. My goal is to help the next 1,000 traders become financially independent and retire early from the financial markets by providing the right tools to use, the rules to follow, and the software to assist you so that you don't make the same mistakes that I made. And from now on, I'll be your personal swing trading mentor to show you the way. So if you're ready, let's do this. Now, Jesse Livermore is famed for being one of history's greatest traders, and he is attributed to having 21 rules that he lived by. Now, I'm going to forego simply reciting them, as several do overlap, but the ones that kind of resonate with me, they're the ones that I'd like to mention today that are most relevant for today's modern trading world. Now, the first one that captures my imagination and attention is that nothing new ever occurs in the business of speculating or investing in securities and commodities. It's a little bit old world English, but nonetheless, a bit of a mouthful. There's nothing new in trading, and this is the first point so true. And when you do read the book, that you'll see that there are certain truths in the markets which were true then and are still true to this very day. And one of the things that might help you and anyone else that is hearing this message is that the markets, from my perspective, the way I like to think about this, and I'll get to a rambling point eventually, but it's the charts are a visual representation of crowd psychology. And one thing that we do know is that human nature rarely changes at all, and certainly crowd psychology hasn't changed a great deal. I mean, our understanding of it has, but the reality is that human behavior and human psychology, it hasn't changed. And if you think in terms of the markets, the stock market, specifically charts, as a visual representation of crowd psychology, then you'll start to see that there are patterns and ebbs and flows, and you'll understand that nothing new happens in the markets because human psyche isn't changing at a dramatic speed, and certainly in the last 120 years, it hasn't changed. Now, what has changed, in fairness, is the speed of movements. Because of technological advances, we do see things happen a lot faster, but the reality is what is happening hasn't actually changed a great deal. Now, another point that really resonates with me is that the markets are never wrong, but opinions often are. Now, this is a lesson that I've learned a couple of times over the last 30 years, and it might explain why I'm very vocal on following a rule-based trading system, as opinions just don't matter. Every time I've tried to trade an opinion, it's resulted in some of my bigger losses because I'm trying to force my viewpoint, my narrative on the markets, rather than look at the data and make decisions on the aggregated money flow of the markets, or the trend if we wanted to be less fancy about it. Then if we'd just followed the trend, I would have been fine, rather than trying to force my opinion, which might be temporarily right, but on average, it's always been wrong. So the markets are never wrong. Follow the money flow. Opinions mean squat. Now, another point that, again, I always kind of harp on about as well, is that one should never permit speculative ventures to run into investments. The way that I've phrased this over the years is don't become an accidental investor. And it's kind of linked to the previous point, you shouldn't trade your opinion, and when it's been proven wrong, you should own it. Don't hold and hope for a different outcome. Take the loss and move on. So don't become an accidental investor. I mean, one story springs to mind. An old friend from the 90s. I remember an investment. It was a company called Dragon Oil in the UK. And, purchased at twopence. It was a penny stock. Purchased at twopence, sold at fourpence. That was my story. But he did the same thing. Bought at twopence, but held, hoping for more. The following year, it's like, it's a couple of months later, it's out of, it's gone from my trading perspective. But a year later, he still got it. 2 years later, he still got it. 3 years later, he still got it. And for all I know, to this very day, more than 25 years later, he's still holding that position, hoping that it's going to, come back and make some money. It's been, reverse split after reverse split after reverse split, and it's worth pennies compared to what it was, or fractions of a penny compared to what it was originally. So hoping that something's going to work out and hoping that there's going to be a different outcome. And essentially, he's become an accidental investor because his opinion was it was going to the moon. And hoping for more out of the trade when the trade was very short-lived in the first place. So again, this is just one more reason why I prefer to use stock options. So this expiration date on the trade, it's built into the trading process. For example, I like to default to 150 days to expiration for the majority of my swing trades, the idea being to get paid at the end of the month or the quarter. And if it's not unfolding the way that I want, I've got until expiration to see if I can manage it better. But at expiration, job done. I can wash my hands of it. So rather than use a physical in-the-market stop loss, I use the price of the option as my built-in stop loss so that I never have this situation where my opinion runs amok, my speculations become accidental investments. Now, also close to my heart is never buy a stock that has had a big decline from its previous high. A lot of people call this buying the dip, and just because a stock is moving lower doesn't mean that it's dipping. It may be moving lower, and one of the qualifiers that I like to add into the buy the dip, because I love buying the dip, I love trading the trend, I love selling the rallies in a downtrend and buying the dips in an uptrend. And listen to the way that I'm describing this. I've added the qualifier in the trend. So just because price is moving lower or perceivably dipping doesn't mean that it's a dip worth buying. We've got to add the qualifier of the trend. Again, many stocks, as I'm recording this, have benefited from, or did benefit from the COVID crisis, like Zoom. It went from, $30, $40, $50 all the way up to, $600. And I love the company. It's a great product and all that. But the stock price is off more than 80% from the frenzied peaks of, the post-COVID movements. And it doesn't make it a good buying opportunity. Again, it may be a great company. It's a good product. I love the products. I am a user. But at the same time, it doesn't mean that the stock is worth more just because it has been at that frenzied price in the past. So follow a proven process. And if it said for you to buy or invest in that particular stock at these prices, then that's great. But just because price is off a significant portion from where it's previously been at, again, in this case, 80% from the highs, it doesn't make it a good buy or a good investment or a good opportunity. By the same logic, Enron would have been a great investment, and very topically, FTX would have been a good investment right now. But the reality is, it's not. So follow the process and just add the qualifier of the trend. As long as the trend is still in effect, then maybe it is a dip worth buying according to your process. Similarly, and again, all these are kind of interwoven and related, as you can probably gather, but never average losses. This is a hard and fast rule. I don't understand the logic of people who average down their losses. Because a stock was a good buy at, for example, $100, now that it's $80, it's got to be an even better buy, and you buy more. And, the stock continues to go lower in this hypothetical example. It's even better at $60, so I best get some more at the even better prices, and you bring your average purchase price down. Again, all that's happening is that your averaging down is often the quickest way to the poorhouse. What we should be doing is applying risk control. If you liked it at $100, it doesn't mean that it's a better opportunity at $50. You know, maybe this is one of the ones that's just not going to work out. We're looking for an average return over multiple trading occurrences, not hoping to get rich quick over one trade idea that's got to be right. So think about it logically. If it's not working out, cut the loss short at a sensible level. You can always get back in later if your system, if your process says, hey, we've highlighted another opportunity here. That's what I do. Again, because I use the timeout choice of my option, if the option expires and I've taken the loss, which does happen, so at expiration is when I generally take my losses in one fell swoop, but if there's a new opportunity to get involved, we'll re-enter the position. It's just that the previous trade idea, it's had its full measure of time, but as long as a new setup develops, I'll be happy to take that because it's over multiple occurrences that I'm looking to get involved. And if you are going to compound into trading opportunities, it's better to compound into the winners rather than the losers. Don't average your loss down with bigger and bigger and bigger position size. It's better to add into and compound into the winning trades. That's a much better way of doing it. For me personally, I've always liked to be in or out of a trade idea. I put my full position on. Again, that's personal preference. I've traded both ways where I've compounded into moves, I've compounded out and scaled out of profitable positions. Again, I prefer to be in or out with my full position size. That's my personal preference. Again, there's a few ways to cut the cloth in this particular case, but what we should always do, or not do in this case, is never average a loss down. Now, this is also, once again, related to wishful thinking. Wishful thinking can spark and trigger lots of bad behaviors and bad habits, but wishful thinking must be banished. Again, hoping and wishing and praying that something is going to come true doesn't mean that it will come true. I think this one's self-explanatory personally, but it's also worth mentioning. Follow a proven process that tells you when to deploy your trading activities. Hoping that something is going to work out or forcing your opinion on the markets is never a recipe for success. Now, last on my dance card of trading wisdom is it's much easier to watch a few than many. Now, trying to trade every stock every day all of the time is going to drive you crazy. It's very easy to have FOMO and bounce around from penny stocks to big cap, small cap, medium cap, whatever the flavor of the day is, gapping stocks, day trading, swing trading. Let's have a look at futures. It's very easy to try to trade everything every day all of the time, and all it's going to do is drive you crazy. Now, it's far better to watch a few things, a few manageable things. I teach all my traders to start off with top 25 stocks. When I started out, I was trading currencies primarily with some index futures. So I looked at 4 currencies and 2 indexes. And 6 opportunities was plenty of opportunities. Certainly it served me for the better part of 12 years. These days I prefer to trade stocks and stock options. Again, personal preference. And I teach all my traders to start with 25 stocks. The best 25 stocks that I consider to be or provide the best opportunities as per the data, the strats, the algorithm, or the backtesting reports. It takes a little bit of time to filter these out, but I've got a master list of stocks that I can draw from, and all I've done is taken the top 25 stocks that my system behaves favorably for. And that's it, that's my entire universe. There is nothing else. I'm not trading the latest flavors, the latest meme stocks, the latest nonsense. I'm not jumping around like a gummy bear, bouncing around from opportunity to opportunity and chasing my tail. All I want to do is farm the best opportunities consistently that present themselves over proven winners that behave favorably for the way that I want to trade. And it's a far more relaxing approach than trying to chase a move that may or may not happen. To eagerly hunt for the 10 bagger. Well, if there's going to be a big move on one of those 25 stocks, I should theoretically always be on it because I'm waiting for the setups and trading the setups on those 25 stocks with the frequency that they occur. So you'll never miss the trade. If there is a 10 bag, you'll always be on it. If there's a time to hold cash on those opportunities and wait for the opportunities, then you're on the sidelines. And it's again, it's just a far more relaxing way to approach trading. Now, obviously, I'm just using the top 25 as an example. If you want to be more active, you can look at the top 50, the top 75, top 100. I look at the top 100 personally. I am quite an active trader, but you're going to start with at least 25 stocks. Now, those were some of my favourite pearls of wisdom that have stood the test of time and still true 120 years later. If you haven't gotten Reminiscence of a Stock Operator already, then I would urge you to get it. It is one of my favourite books, and not just one of my favourite trading books, it's actually one of my favourite books to read. It's easy to read, there's not a single chart in it, although probably some of the more modern ones have some illustrations in. And if you have it already, read it again. It is quite literally the best $10 you will ever spend. I'd get the physical copy, you can make notes in the margins, but it's well worth a read if you haven't read it for a while or haven't read it at all. Definitely worth the effort. There's always something to learn or relearn within its pages, and these are some of my favourites that I've certainly taken to heart over the years. Now that's all for today. If you like what you've heard, be sure to follow and listen to the very first episode where I map out the first of my 6 most profitable money-making patterns. As always, thank you for giving me your time and attention and making me a part of your regular routine. Have a wonderful day, and I'll speak to you at the same time next time. And toodaloo for now. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Anti-Investor provides educational information and does not provide financial advice.